and welcome to this exclusive conversation we're having with Jahangir Aziz of JP Morgan, joining us all the way from New York. Good evening, Jahangir. Thank you very much for staying up and chatting with us this morning in India. Interesting budget in terms of what happened yesterday, a very confident interim budget from a government in full command. Is that what you also made of the interim budget announced yesterday? And also, this budget does go down as one of the shortest budgets in the recent history.
So first of all, it was an interim budget, right? And so, and they kept to the spirit of the interim budget, but didn't announce big tax policy changes, big expenditure policy changes. So I think we need to appreciate that even despite the fact that it was an election year, they did not go down that route. And we always worry before an election year that governments are going to go profligate. But if you look at the past 4 or 5 budgets, the government haven't done that. Even in 2014, when I'm guessing that the UPA governments were facing serious challenges on the electoral front, they stuck to the interim budget spirit. So in that sense, I think the government needs to be applauded that they stuck to the interim budget's institutional integrity. In terms of where are the big sort of surprises, I would say that we had a fiscal consolidation path where we expected that the government would target about 5.2% of GDP. A lot of people were skeptical about that number. It turns out that the government went better than that and is targeting a 5.1% fiscal deficit target. And I think that this is truly needed at this juncture, given, you can have quibbles about the growth rate, right? Whether it's 6.5, whether it's 7, whether it's going to slow down to 6, or whether it's going to rise to 7. But broadly, whether it's you're looking at the remainder of FY24 or looking forward to FY25, growth is broadly going to hold up in that range, right? And you still have, a reasonably strong disinflation that is continuing. Inflation is not yet in the comfort zone of RBI. But my guess is that if you wait long enough, it will get there because most of the disinflation that is happening because of global supply chains have normalized and because China is exporting a significant amount of deflation at this point in time. And those things are in play even now. And then if the Fed cuts, depending on when the Fed cuts, whenever the Fed cuts, I think that opens up space for the RBI to ease monetary policy. So there was no real reason to provide any kind of macroeconomic support coming from fiscal policy. And therefore, that was the right thing to do, is to start paring on fiscal deficit and, sort of create the space for the next contingency that might happen. Who knows? We never expected the pandemic to hit us. And at the same time, try stabilizing public debt, which has actually been rising. And, our estimates suggest that this year is going to be somewhere around, 83% of GDP. This public sector overall debt. Compare that to the pre-pandemic 70%. So we have seen a significant increase in public debt.
Jahangir, let's take this one at a time, right? The fiscal deficit number was truly a surprise, like you said. At least the path has been laid out. Now, how credible, how realistic this goal is going to be anybody's guess over the next couple of quarters and the next year ahead. The direction is in place. The borrowing numbers seem to please the bond market as well. Before we talk about the liquidity, the bond market, the inclusion on the JPM, do you feel like this budget now puts the onus on the RBI at its next monetary policy meet to do whatever it needs to, may or may not be in tandem or in line with what the Fed does?
I think it makes RBI's case to start cutting rates a little bit stronger. My guess is that RBI in the next meeting will do a Fed, which is to say that, look, we are comfortable with the pace of disinflation. A lot of progress has been made, but we still need to see few more data points before we are truly convinced that inflation is on a downward trend, and therefore essentially open the door for easing sometime this year, but not promise anything in the near term. But I think that an excuse, which would be that whether there hasn't not been enough amount of fiscal consolidation, that excuse no longer holds. So I think yes, it puts the onus on RBI, but I'm guessing the RBI will do a J power of yesterday.
Wouldn't surprise us because also largely the rate differential will have to be kept in mind. Apart from the
That's right.
local macros, I think if the
Yeah,
Fed doesn't move, emerging market like
yeah,
India may not even be able to act in
can't
that
move.
direction.
Yeah.
Let's move on from there. And I'm thinking the big trigger and the big talking point pre-budget and during the budget conversation that we had was India's inclusion in the JPM. Now, this, the anticipation is going to bring in $25 billion of money and liquidity into the system. Is that a fair expectation, Jahangir? I mean, you're sitting outside
Yeah.
at JP Morgan, talking to more people than I can imagine.
Yeah.
Give me a sense of what that means.
So that $25 billion is essentially arithmetic, right? So every month the weight of India would be increased at 1%. So in about 10 months' time, it will reach 10%. The amount of money that follows that index, the dedicated money that follows the index, is about 250 to $300 billion. So 10% of that is 25 to $30 billion. But there's more money, right? This is the off-index investors, and that is another reasonably sized chunk of money that will come in. So I don't think we should only look at the 25, $30 billion. We should look at something more. The question is, at what pace does it come in, right? And the pace in which the off-index money comes in, that crucially depends upon, as we were talking about, the interest rate differential. So unless you see a significant tick down in the 10-year US yields, that discretionary money, which doesn't have to follow the index, can take its time. So I would say over a 2-year period, you should be looking at a reasonably sized inflow coming into India.
Do you also think this could be more directional, of course? So with India's inclusion in the JPM, there's also conversations that we might be in the Bloomberg bond index.
Sure.
Now, with this very strong commentary coming in where, you've got to wake up and notice India now, right? And the Prime Minister's done that. He's not just put us on the map, but he's also created a very credible growth dominated country. Could this also mean that with this 5.1% number, 4.5% target number in FY26, we could see some more inclusions come our way, and that could again spur up the bond market?
Yeah, I mean, it's typically the case that, GBIEM is the most followed index, right? So typically the case that when country gets included in GBIEM, the other indices also start including India. And I wouldn't be surprised at all if India enters into a bunch of other global indices. I think there is a difference between, the money coming in and what impact it is going to have on rates and FX. I think there is a misunderstanding that all of this money that is going to come in is going to appreciate the currency and bring down, the 10-year rate or create a massive rally in the bond market. But that depends entirely on what the RBI does with it.
I'm glad you.
My sense.
Yes,
No,
please
no,
go
go
on.
ahead, go
No,
ahead,
no,
go
go
ahead,
on.
go
I'm
ahead.
so glad you brought up the currency because that's one thing we haven't talked about. This excessive flow is going to disturb and make the rupee more volatile. I know it's not a volatile currency as such, but it will, induce volatility in the currency markets.
Look, we live in India. We live with a central bank that is probably the most activist or interventionist central bank. My guess is that almost all of this flow will be first intervened in the FX market. And then, because it is going to inject this massive amount of liquidity, RBI is going to sell exactly the same number of bonds so that the yield curve does not move. This might be a caricature or an exaggeration of what might happen. You could see some modest appreciation and some modest rally just to keep people interested. But I think the intervention, both in the FX market as well as in the bond market, will be significant based on the amount of money that we get in.
Right. Let's switch gears, Jahangir. The Prime Minister, and I'm going to come back to consumption in a minute, but the Prime Minister talked about a very ambitious target of making India a developed country by 2047. Now, while that looks and sounds fantastic, he talked about the focus of the government's target constituency,
Right.
farmers, youth, women, poor, groups that transcend the division of religion and
Yeah.
caste. So really glorious statements in that sense. But to achieve that, is it realistic? One, what needs to be done? Because currently, with consumption constituting only 61% of GDP and investment slightly about 30%, that run rate may not be as achievable. Would you agree?
So, in by and large, I stop myself from talking about things that are probably, beyond even my lifetime. So what happens in 2047 is so far away that, it's very hard to, even think about that. But then, political leaders have to have vision. And I think that it is an aspirational goal. And I think that if we even manage to get half of it done, it would be a significant achievement. Now, all of this boils down to what you consider to be a developed country, right? I mean, one of the criteria that we normally use is per capita income. I know there's a lot of focus on just in the size of GDP in India and in the market because the size of GDP matters for markets. It's the size of the market that you're creating. But ultimately, development means that what happens to your per capita income. Now, if you think about per capita income reaching developed market standards, right? So you're around what $2,500 per capita income, right? Um, you know, to reach 60,000, $70,000 per capita income, you need remarkable growth rates. And that's a very tall order.
And 6.5% is not going to cut it.
And 6.5% does not get you $2,500 per capita to be 60, 65,000 per capita. I think that's always been a problem when we talk about these kinds of comparisons. I remember, people were talking about, if you go back 200, 300 years, India was the largest or the second largest country in the world, pre-British time, etc. All of that is true the size of GDP. India's GDP was large, China's GDP was large because India's population was large. India's and China's population was large. If you look at per capita income, the country that has significantly been on the higher end are much, much smaller advanced countries such as Italy. We don't talk much about Italy these days. I think we need to get a sense of perspective in all of this. Yes, GDP can grow, but can per capita income take us to the 65,000 dollar mark? Again, within a generation, that too. That's a very tall order.
I agree. Well, Jahangir, step back on consumption. We were all, I mean, there
No.
are some parts of, people in India, economists, market participants, brokerages as well, that expected this to be a slightly populist budget. One, it's election year. Two, consumption has been struggling, and we've seen that with quarter-on-quarter earnings being reported by companies that have a focus on the rural part of this country.
Yes.
Not much was done there, in my opinion, at least not the obvious. How do you feel about this? Do you feel like more needs to be done to spruce up consumption? Because that is a part of the country that is struggling.
So I wouldn't simply look at, low end versus high end or rural versus urban consumption, but just look at consumption per se. Consumption per se has been, as we've been pointing out, has been trailing GDP growth. But it's not just private consumption, it's also private investment. Private investment hasn't really done very much. There has been very little crowding in, quote unquote, from the very large expansion in public expenditure. So it is that the private sector isn't spending as much as they should be, both on the consumption front as well as on the investment front. And this is one of the reasons, and we don't talk about it much, this is one of the reasons why the public sector can get away with 8, 9% percent of GDP borrowing year after year, because there isn't any real funding pressure that is being imposed on them. So I think it's a real problem. It's an imbalance that should not be allowed to fester and become into a fault line. I don't think much has been done in this budget to address that. I don't think the budget per se or fiscal policy per se can do much about that without other policies and other ministries changing their policies. And I think this is a conversation that, because it was an interim budget, we didn't have much of that. I think, and the government got a pass for it. But I think in the July budget, this will be a central issue.
Jahangir, elaborate on that because that is important. We've all been talking about how great this budget is and how boring it was, but still good and lays out a roadmap. You mentioned this twice to me that public sector borrowing is a pain point. What do you think needs to be done? I mean, in actuals and on-ground movement, what would you like to hear from the finance minister in July to show a path of consolidation there too?
So I would say that, at least stick to the 5.2 on the central government side and move towards the 4.5. Try convincing the state governments that they need to pare back from the above 3% deficit to at least back to what used to be the norm before, which is 2.5%. But even if you go to the 2.5% and 4.5%, let's say by FY26, which is the target date, right? Even then, for India just to stabilize its debt to GDP, which is running around 83% today, as opposed to just 70% in just before the pandemic in FY19, you would require a sustained growth around nominal GDP growth around 10%, which translates into a sustained real GDP growth around 6.5%. And again, these are very, very high benchmarks to be achieved. And I don't see how that can be achieved without investment finally turning around and consumption doing its part. So I think even if we are thinking about an overall growth trajectory of 6.5, it is imperative that we start bringing investment back in. And I think that there are two parts to why investment has been languishing. Investment hasn't been languishing just because of the pandemic. If you go back from 2000 and I would say 10 onwards, corporate investment has sort of struggled to breach the 10% of GDP. It used to run around 15, 16% GDP before the global financial crisis. It hasn't moved since then. This corporate investment. SME investment has actually declined. And I think these are reflections of structural issues more than simply that whether there's a cyclical boost or cyclical cuts in taxes or incentives that you can provide. And I think that's where the agenda has to be. That it isn't a question that it just happened just after the pandemic and okay, once the pandemic woes go away and the uncertainties, global uncertainties go away, investment is going to go back. Investment hasn't gone back since 2010.
Right, that is, those numbers, yeah, are a little nerve-wracking. No, investment hasn't gone back since 2010, and that's what really needs to come on board to help
Yep.
India achieve the goals it's setting out for itself. We've talked about consumption, we've talked about bond markets, normal growth as well. Anything else that was a standout, Jahangir? I know the onus now only moves down by a few months, and we'll all be waiting and watching, but anything else that caught your attention that we might have missed out in the fine print?
So I would say that the narrative that has been being provided by the government about where India's headed, that I think in the July budget will have to will be tested in the sense that are you putting your money where your mouth is? And I think the kind of investments that India needs to do, and these are very normal investments. These are not outlandish investments, particularly in education, particularly in healthcare. You cannot possibly think about India achieving the 6.5% growth rate if the education level and the skill level of the population isn't increased and increased rapidly, or that the health of these workers that will be coming to the job market isn't significantly better. And I think these are two areas where a lot of innovative financing, a lot of innovative policies can be done. Other countries have done that. And I think that we will have to look much more carefully into the role of the private sector in delivering these outcomes. Government by itself cannot do it. you do have a lot of private sector participation in public education, but if you count, there are handful of universities, for example, that are truly private sector. Most of them are professional institutions, which are sort of are deemed universities. So I think we really do need to focus on this issue. And again, on the healthcare system, I mean, the numbers are pretty damaging if you think about that this is a population that is becoming younger and needs to actually deliver, you know, at least 40 hours of work day. I'm not even talking about the 70-hour work day that some people have been suggesting.
No, you're right. I think a few months ago when Dr. Raghuram Rajan indicated the same thing, education and healthcare, I think those are the two biggest drivers which this country currently is missing. Uh,
Right.
so,
And I think that you can't put everything on the finance ministry.
yeah,
They can't solve. The other ministries have to play their share. I have to come up with their contribution to it. It is not a financial engineering problem. It is a much deeper structural issue that involves a lot more ministries to get this problem, resolved.
no, and I think there are two Indias in our country, right? There's one which is moving faster than China and getting richer, while the other half is being still given out food packets. So clear divergence.
Right, and these are imbalances that that are expected to happen if you have, you know, major shocks hitting the economy one after the other. I mean, think about the shocks of the last 4 years, right? You had the pandemic, then you got the Ukraine war-related spike in commodity prices, then you had this, most aggressive rate hike by the U.S. Fed since the 1970s, and then in the midst of it all, China, which was one of the largest engines of growth for emerging markets, sort of go into lockdown for an extended period. So these are big shocks, and how those shocks affect different groups of people, they don't affect the different groups of people the same way. So you do expect imbalances to take place in the recovery period. The problem is you don't
Interest.
want these imbalances to widen because then they turn into fault lines. And if they turn into fault lines, then it becomes very hard to imagine, how overall growth or overall state of health of the economy can be maintained when you have such deep fault lines forming in the economy.
So true, Jahangir. Does that also mean that a rating upgrade is still very far out for India, despite the fiscal math intentionally at least looking like it's on the right path?
So if you go back to the rating agencies, right, and if you go look at why they gave India the investment grade, despite the fact that its peer group, right, had significantly lower GDP, public sector debt, right. So if you look at India and compare it to other countries in the same investment grade category, India has one of the highest, in fact, the highest debt to GDP ratio. So the rating agencies gave India a pass on the argument that most of this debt is held domestically.
Right.
And now we are opening the can of worms.
Well, Jahangir, very lastly, with everything that we've talked about, I think one of the objectives potentially of this budget could be to draw those FDI, FI flows that has also been lacking.
Yeah,
Beyond the JPM, beyond everything that is more,
yeah.
investment related of that sort, are you expecting long-term money to come into India on back of these improvements, the few improvements that
Yeah.
we are seeing far and in between India?
So I think that, I'm sure you've seen the chart, right? This is a chart related to China. China's FDI used to run at $334 billion run rate. Now it's collapsed to near zero. And people point to that chart and said, look, this is proof of relocation. The problem is that if you look at every country's FDI has fallen. India used to run around about 60, $70 billion. That's now struggling at 20. Same thing in Brazil, same thing in Mexico. In fact, it's the same thing in the US and it's the same thing in Europe. And the culprit happens to be the 10-year. So if you draw the map, if you draw a chart of India's FDI and place on it the 10-year rate, it's almost explains everything. It's very easy to talk about FDI and services where you are going to deliver pizza by, cycling backwards in the traffic when interest rates are zero. It's a completely different ballgame to fund such kinds of investments when you have interest rates around 5 and probably more if you're going to borrow privately. So I think you need to see the Fed start cutting rates. You need to see the 10-year come down to more normal levels. And I think once that happens, you will see FDI coming back. But it is very, very difficult to see someone putting in bets on a 10-year or 20-year project when the funding cost is about 5, 6% in the risk period.
So the culprit, Jahangir, is the Fed and is the 10-year.
Yes.
Yeah,
Yes.
I'm gonna take that away. But Jahangir, great talking to you as always. Hopefully we can catch you for a slightly longer conversation over the next couple of months. And please let us know if you're visiting India. We'd love a chat on that too.